Higher long-term yields, a surging gold price, and a pivotal week for artificial intelligence earnings are all hitting at once, forcing equities to reassess both growth and discount rates. You are watching vTalkInsight, Equity Pulse Daily for August 24, 2026. Let us unpack how a fiscal-dominant bond market and an AI-driven profit cycle are colliding in today's equity backdrop. Long-term U.S. yields remain the main gravity force for equities, and this week's Treasury actions have only reinforced that point. 30-year yields are hovering a little above 5%, after briefly pushing closer to 5.3% earlier in the week, keeping the discount rate on equity cash flows uncomfortably high. The Treasury now plans roughly $4 billion of buybacks next month, aiming to relieve illiquid pockets and steady the long end of the curve. Supporters see this as a twist-style operation that can compress term premiums and limit the room for bond vigilantes to force yields sharply higher. Skeptics, though, are focused on both optics and arithmetic. Announcements outside the usual refunding calendar add a layer of policy unpredictability, and swapping low-coupon legacy debt into today's higher yields risks worsening the long-run fiscal trajectory, feeding the narrative of the Treasury acting more like a trading book than a conservative debt manager. Beneath those tactics, the regime story has barely changed. Public debt above $40 trillion, deficits anchored by Medicare and Social Security, and no credible bipartisan consolidation plan keep markets in a fiscal-dominant world. At the same time, record AI and telecom bond issuance, reshoring-related capital spending, and fewer price-insensitive buyers are lifting the marginal cost of capital. Put together, higher for longer at the back of the curve looks less like a slogan and more like the base case, and that directly constrains how far equity multiples can stretch, even with earnings still robust. On top of fiscal worries, uncertainty around the Federal Reserve's reaction function is adding its own premium. Markets are questioning how committed the Fed really is to a 2% inflation target and what it will tolerate if financial conditions loosen while long-term deficits stay high. That doubt is raising the compensation investors demand to hold duration. Attention is now fixed on Jackson Hole and upcoming comments from Chair Kevin Warsh, as well as the next personal consumption expenditures inflation release. With diesel and jet fuel prices near $200 a barrel and refinery bottlenecks acute, energy alone could keep PCE readings uncomfortably firm, complicating any attempt to sound dovish. Bond market volatility has risen to levels more typical of emerging markets, and that stress is showing up in cross-asset flows. Institutional allocators are leaning toward cash, short-dated fixed income, and gold over long-duration bonds, reflecting concern that another policy misstep could extend this higher rate environment rather than normalize it. Gold, in particular, has become a lightning rod. Prices are up more than 30% this month and have logged a third consecutive weekly gain, supported by central bank buying, renewed inflows into gold exchange-traded funds, and long gold, short dollar trades. Much of that reflects anxiety over fiscal sustainability and future currency debasement. The main risk to that trade would be a hawkish surprise from the Fed, such as a rate hike into the autumn, which would raise front-end yields and test the metal's recent momentum. Equity indices are caught between that rates backdrop and still powerful earnings. The S&P 500 rebounded into the weekend, but looks set to break a 3-week winning streak, while the Nasdaq 100 has just posted its sharpest weekly decline since July, down close to 3%. Even so, more than 70% of S&P names are trading above their 200-day moving average, a sign that breadth remains healthy. Leadership has clearly rotated away from a narrow group of mega-cap AI winners toward a more diversified tape. Equal-weighted indices and small caps have been participating more, and previously lagging pockets of the market are finally contributing. At the same time, there is a clear tilt toward quality inside that broadening, especially within technology, communications, consumer staples, and utilities, as some investors signal that bond yields may be near a cyclical peak. On valuations, strong earnings are doing more of the work. Profit growth around 35% year-on-year is helping justify current multiples even as the equity risk premium compresses. However, Aggregate cash balances relative to market capitalization are low by historical standards, suggesting there is less untapped liquidity on the sidelines to power an additional leg higher without either better growth or lower yields. Globally, dispersion is stark. Emerging market equities and bonds have outperformed U.S. assets this year, helped by AI exposure in Asia and commodity revenues elsewhere, and a weaker dollar is acting as a risk-on catalyst for non-U.S. markets. Japanese equities remain a bright spot, supported by improved corporate governance and higher shareholder payouts. Europe is more strained. Despite roughly 18% earnings growth and better-than-expected purchasing managers' indices, regional indices are on track for their longest losing streak since 2016, pressured by gas price spikes, diesel shortages, and the prospect of further European central bank tightening. The single biggest swing factor for equity leadership remains the artificial intelligence build-out. The semiconductor sector is experiencing unprecedented growth as governments and corporations pour capital into generative AI infrastructure. Investment-grade issuance tied to AI and telecom is forecast in the hundreds of billions of dollars, and that surge in borrowing is itself a driver of higher yields. Nvidia sits at the center of that story. The company is expected to report revenue and profit growth close to 100% year-on-year, marking roughly a 13th straight quarter of exceptional expansion. Management has already guided to robust demand through this year and into next, and markets largely want confirmation rather than surprise. The stock has recently begun to outperform the broader semiconductor index again as a new product cycle ramps, even after a 6-day losing streak highlighted how sensitive sentiment has become. Yet the bar is high. Despite that growth, Nvidia trades on something closer to a market multiple than a classic hyper-growth premium, which suggests investors are already discounting intense competition and future capital discipline. Concerns range from rival chips at Alphabet, Broadcom, Amazon, and AMD, to advances from Chinese players such as Huawei, and to the idea that sustaining today's breakneck AI capital expenditure pace will be much harder by 2027. Broadcom underscores how capital-intensive this cycle has become. The company is arranging more than $60 billion and potentially up to $100 billion in new debt via special-purpose vehicles to finance AI chip deals, including support for Anthropic. Analysts estimate that chip-backed exposure could reach around $370 billion by 2029. Yields in the 7 to 8% range are attracting capital, but they also mean AI projects must clear a much higher hurdle rate, and they shift some risk from equity to credit markets. Importantly, the bottleneck is moving. Chip and memory shortages are easing faster than expected, while power availability is emerging as the binding constraint. The AI infrastructure build-out is estimated to require at least 150 gigawatts of new power over the next 5 years, implying around $5 trillion of associated investment. That supports mid-cap industrials tied to data center construction and grid upgrades, but it also feeds inflation pressures because energy and hardware costs are rising before productivity benefits fully materialize. Turning to the real economy, company-level signals point to a two-speed consumer. Citigroup has cut price targets for Walmart and Lowe's on concerns about weak comparable sales and pressure from elevated gasoline prices. In contrast, off-price and wholesale retailers are thriving. Ross Stores has raised its full-year earnings guidance again and plans more store openings, while BJ's Wholesale Club has also upgraded its outlook after beating second quarter expectations, highlighting strong traffic from value-focused shoppers. Healthcare is another area regaining momentum. Moderna shares have surged after late-stage trial data for a personalized melanoma vaccine developed with Merck fueled optimism about a new oncology revenue stream. More broadly, the healthcare sector is drawing attention because it combines relatively low earnings expectations with improving price action, offering a way to add growth without leaning solely on AI-exposed technology. Individual stock moves also highlight execution risk. Boston Beer dropped after its chief financial officer announced his departure, raising questions about the durability of the company's margin recovery. These kinds of idiosyncratic events, from management changes to guidance resets, are becoming increasingly important differentiators in a market where index-level valuations already embed strong macro and earnings assumptions. Energy markets are a separate but related driver. Diesel and jet fuel prices have jumped toward $200 a barrel, with refining margins running at roughly 5 times normal levels as global refinery runs sit about 8% below last year and unplanned outages hit the Middle East and Russia. European gas prices are up 40 to 70% with storage low, raising the risk of an energy crunch into winter. That combination boosts margins for well-positioned refiners and energy infrastructure firms, but it also tightens the squeeze on households and rate-sensitive sectors, reinforcing the stagflation risk that equity markets are now slowly beginning to price. Stepping back, the equity landscape is being pulled in opposite directions. On one side, a fiscal-dominant, higher-for-longer yield backdrop, an energy shock and elevated bond volatility are raising discount rates and keeping a firm lid on how far valuations can expand. On the other, earnings growth remains exceptionally strong, market breadth is healthy, and the AI investment cycle is still generating powerful profit and cash return stories across semiconductors, industrials, and select services. For now, that tension is expressing itself through rotation rather than collapse, with capital moving toward quality, value-oriented retail, healthcare, mid-cap industrials, and hard asset exposures, while more speculative corners of technology and Europe absorb the brunt of yield and energy shocks. The next phase is likely to be defined by a handful of catalysts: Nvidia's earnings and guidance, Chair Warsh's comments at Jackson Hole, upcoming PCE inflation data, and the Treasury's follow-through on buybacks and issuance. How those events resolve will shape whether higher yields finally break the AI-led equity rally, or whether profits and productivity once again buy the market more time. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.